So a quick video today, guys, to talk about this blog post that I actually just put out, and I'll link this in the description below for anyone that's interested in reading it. But I do think there's some interesting takeaways on for Monday that I want to talk about today. Today being the 10th of September, 2021, just FYI. So we had this ugly day in the market on Friday. And this was spurred by a lot of people once again, talking about kind of this is going to be the end of this bull run. It's look at this really ugly candle we had, and a lot of that I saw traders I talked to and FinTwit and all of that. So myself, if you guys follow me at all, if you don't, all of the different ways to follow me and support me are in the description down below. But I am a chartered market technician, so I've been trading for many years. I'm a technical analyst by trade, but I always partner that with statistics. I like the combination of statistical analysis and technical analysis, the way a lot of people like looking at fundamentals or stories and then combining that with technicals. I do kind of the same thing, but with a lot of statistics. So as I was looking at this day, and everybody seemed to say, well, that was bearish. What a bearish day that occurred, got me thinking. So I was able to go in and grab some data back from the S&P 500, and I was able to do some testing. So that's kind of what I'm going to talk about today. Again, this full blog post in the link below with all of the statistics and everything that I came from. But this is the number I kind of want to focus on, where, first of all, how I did the math and how I did the statistics was basically by saying, okay, if it is a very bearish day, when you have a stock that opens or the market that opens and closes at the low of the day, then what we should find is that by buying this low and holding it for a couple days later, that's a bad idea, that ends up losing us money. What I was able to find, again, just by running this math, is that it seems to be the other way around. Now, again, this is just all probabilities. I have no idea what's going to happen on Monday or next week or going forward. Neither does anyone else. And if you find someone who says, oh, yeah, I know, run, right? But the probabilities seem to say that we have about a 63-ish% chance of bouncing and closing higher than we did now 3 days from now. The reason I did 3 days and not like 5, 10, 15, or 20 is just the market has a natural drift higher. So I just want to look at the closer short-term time horizon here. So what I did to do this, I basically grabbed a filter that we have in Trade Ideas called the position and range. And I was able to rebuild that in some softwares that I could do some longer term tests, some stuff that I have access to in Trade Ideas that should be out for some of you guys soon, but for now it's just for me. So I was able to go back to 2009. And basically what I did is I simulated a portfolio and I said, hey, every time the SPY closes within the lower 20% of its range. So how the position and range filter in Trade Ideas works, basically takes the top of the range and says that's 100% of the range, and takes the bottom and that's 0. So if the stock closed right in the middle of the range, we would call that 50%. If it closed right at the low tick of the day, that would be closing in 0% of its range. So we take the range, we express that as a percentage, and this is where it's going to close at. So I said, what if every time over from 2009 till today, when the SPY closed in the low of this 20% of the range, so closed near the low of the day, if we bought it with a $10,000 account and held it for 3 days, what would be the outcome? So again, in 63% of the time, a little bit short of 2/3 of the time, in the next 3 days, we were up by average of 1.34%. When it didn't work, so that other 40 or 36% of the time, give or take, you lost about 1.3% as well. So not really much of a risk reward benefit there. However, because of the probabilities, right? The fact that it happens more often than it doesn't, again, going back from 2009, this is the equity curve that is derived at. So I wanted to go into the chart and just highlight it the last couple because I couldn't be bothered going back further than that, but just know that the data set that I used was 2009 to date. The reason I did that is because, right, 2009, you have a good mix of bull and bear and sideways markets in that time period. So you can see I highlighted here with these orange arrows a couple of cases where this occurred. One thing that I will note in a lot of these cases, it doesn't seem to nail the low. The opening of the next day or even the day after that sometimes signifies the actual low. There's a handful of times where this does as well. But again, in 63% of cases across this universe, 500 or so trades, there was a bit of a profit there. So the larger discussion that I wanted to bring up with this is that when you see that conventional wisdom in the market is saying that's very bearish, we closed at lows, don't just read that and accept it, right? And that's kind of like a big thing going on in society today as a whole. Just don't read what you see online and go, well, that's got to be the truth. Find a way to do some of your own testing. So what I'm going to do going forward is when I see this occurrence, I'm going to start then looking for buy points. I'm going to use these closed at lows scenarios as potential entries, assuming certain things like, the trends in place, and I like the chart and I like all of that. So within trade ideas, again, you can use the position and range filter and then just look for position in range when it comes to a daily chart or even a 5-minute chart or a 15-minute chart. You can scan for all of these position ranges, weekly charts and monthly charts as well. Whereas again, the traditional wisdom would say, hey, if it closed at the high of the day, it's probably going to go higher, and if it closed at the low of the day, it's going to go lower. That might be flipped. Also, and this is something I'm going to do a blog post about a little later next week, I did the opposite. What happens if you bought the market every time it closed at the high of the day and then held it for 3 days? I need to do a little bit more studying on that, but again, it looks like the conventional wisdom is once again wrong on that. So again, main reason for this video is I want to point you to my website there where I have that blog post. And again, if this is the first video you've seen of me or anything, check out all the different ways to follow me below. I trade and I like this combination of statistics and technicals. And if you like this video, if you want more of this kind of content, again, hit the like button, subscribe, share it around, all those things. And I will talk to you guys soon.